Folks, alarms are going off. The latest data shows that consumers have evaporated through almost all of their savings, and guess what? Credit card debt is ballooning at a pace that we have never seen before. And at the same time as all of this is happening, inflation is getting worse, not better. In this video, we will violently walk you through exactly what you need to know. Number one, we are going to discuss the devastating inflation news on the report that was released this morning, what it shows, and what it indicates is going to happen tomorrow on tomorrow's CPI release. Number two, we're going to discuss the dire situation that the consumer is in right now, and make no mistake, once you look at this data that I'm going to present to you, you're going to be like, shite! This is real bad, a lot worse than media is making it out to be. Not the shallow recession and slight dip in purchasing power that we were promised. If you want a well-rounded perspective on what is going on today, make sure to watch this video to the very end. And I promise you, we will deliver on that. Let's get to work, timestamps below, and this video is brought to you by the up to 15 free stocks that you can get when you sign up and deposit with a very powerful platform and broker, Moomoo. Australian viewers can get up to 50 AUD cash back. While many people in this economy are maxing out their credit card debt and eating up all of their savings, you should max out the amount of free stocks you get and eat up all the powerful weapons you can get with Moomoo using our link down below. Okay, let's get right to work. So wholesale prices rose more than expected in September, despite Federal Reserve efforts to control inflation, according to a report Wednesday from the Bureau of Labor Statistics. You go over to the actual stats, it was accepted on Wall Street that we would go from disinflation in July and August back to inflation in September. However, the consensus was a growth of 0.2 month over month. Unfortunately, that ended up being very wrong, and we got a 0.4, which is twice as bad as analysts had expected. Keep in mind that the market and the media was trying to sell everyone back in July on this concept that inflation would be straight down. Hey, it's never been like that in history, but this time, for some reason, it would be straight down, no more problema. And on this channel, and pretty much anywhere where they have common sense, we were warning, hey, inflation isn't just going to go straight down, it's going to be long and painful. Markets are way too rosy, but yet markets continued rallying because, oh no, the Fed's going to pivot because inflation is well behind us because we had a small pansy downtrend. Well, guess what? It's just a few months later, and it turns out that that pansy downtrend was very short-lived. We've now reversed downtrends in food pricing and energy pricing. We were told, oh, energy is going to continue going down into the fall. Guess what? No, it has gone up. Now, this report is the PPI, the Producer Price Index, and the big report that people like to watch, the CPI, comes out tomorrow. PPI essentially measures what businesses pay wholesale for goods and services, but the CPI measures what consumers pay at the final stage. So here's the thing, if the PPI comes out hot, that means that regardless of what the CPI says, businesses are seeing increased pricing pressures. They're paying more for things. So when that happens, businesses have two solutions to that problem. Number one, they could either eat into their own profitability, their own profit margins, and refuse to increase costs on the consumer, which doesn't have an impact on the CPI, or they can go ahead and raise costs on the consumer, raise the costs of their goods and services, which then does increase the CPI. So tomorrow, if CPI comes in under expectations, that means that businesses are getting destroyed. Their profit margins are getting destroyed. They are deciding to eat costs, probably because they don't think they have pricing power in this kind of economy, or number two, they are raising costs on consumers, and consumers are getting destroyed. So it's like no matter what the CPI says tomorrow, whether inflation's hotter or cooler, that's still bad news, because somebody is getting screwed regardless, because pricing pressures at the wholesale level are still out of control. And you look at the year over year here, we are talking prices up 8.5% from this period of time last year. How many businesses have an 8.5% margin for error to work with? Not many. You look up the average profit margins, the average restaurant has a profit margin of about 3 to 5%, according to toasttab.com. A grocery store profit margin is around 1 to 3%. Investopedia says that a healthy profit margin for a small business is around 7 to 10%. Let me tell you, a lot of small businesses are much lower than that. But regardless, if you have an 8.5% increase in your costs year over year, you either have to decide to take the loss, which could mean your business goes out of business if you have a lower profit margin or close to it, and or you raise your prices dramatically. And of course, many companies raised prices dramatically last year because they were having prices raised on themselves. But now it's a completely different environment. And as we head into the new CPI report tomorrow, it will be very, very interesting to see how businesses are reacting to these increases in a world where consumers are less and less able to pay top prices for goods and services. Why and how do I know that consumers are less able to pay top prices? Well, here are some facts. Right now, the U.S. personal savings rates are lower than they've been since right before the 2008 crisis and much lower than they've been during any of the other decades prior to that, meaning Americans are able to save less and less of their incomes. And in terms of total cash left in savings accounts, that's also at a record 10-year low. American savings are somewhere around the same levels we had in late 2008, around 14 years ago, and not even adjusting for inflation during that same time period, which was pretty extensive. And if you separate out the data on savings, say if you just focus on the bottom 80%, I guarantee you the numbers are way, way worse. Most of these savings belong to people who are in the upper quintiles of wealth in the US. The wealthiest people in our society are carrying tons of cash right now and are pushing up the total numbers, and they're very, very happy. They're licking their lips because they're going to get great deals on assets across the board, and then they're going to own even more of the US. The politics of wealth is very, very interesting to me because the pumping and dumping of asset prices tends to correspond with excessive government spending, which tends to be sold as income inequality reducing or wealth inequality reducing. You close the gap. Yet at the end of the day, it usually consolidates more and more wealth at the top. But the point here is the average consumer is getting gutted. And then you could say, Charlie, are you stupid? What about credit cards? They could just spend more on credit cards. Well, they have been doing that, and it's getting to the end of the road. The bottom 90% in the US already saw their debt increase by $300 billion over the last year, the biggest jump ever recorded. Obviously, we print more money, so new record highs always happen when it comes to the nominal value of dollars, but the pace is key. According to Bloomberg, 60% of credit card debtors say they have been in credit card debt for at least a year, up from 50% a year ago. The share of those who have been in debt for over 2 years also increased to 40% from 32%, according to the online credit card marketplace. So Americans, consumers are taking out more debt overall, and they are holding onto that debt for longer, specifically credit card debt. And by the way, if people are holding onto debt for more than a year, that means that they are holding on debt from last year when the economy was supposedly strong and in a huge recovery mode, right? So if they are taking out that much debt during a strong market, imagine what they're going to have to do during a bad one. With inflation exceeding wage gains, more households have relied on revolving debt. Consumers in their 20s and 30s and those in the lowest income brackets are more likely to carry a balance to cover daily expenses such as groceries, childcare, or utilities than older generations, the report shows. But re-listen to this crucial part hither. The reason they are turning to credit cards and carrying balances is because of daily expenses like groceries, childcare, or utilities. Now, in a healthy economy, some people will get into excessive credit card debt by excessively spending beyond what they need to live and, of course, beyond what they make. They go out to eat too much, they spend too much on clothes or luxury items, maybe they spend too much on their car payments, perhaps they spend a lot of time traveling to exotic locations. Consumers in healthy economies may go overboard spending in those categories and rack up some consumer debt. But here, what this data is showing is that consumers are getting into debt not for these extras, they are getting into debt for the essentials. Groceries, childcare, and utilities. These things aren't excessive items. They're not excesses. They are mandatory items to live, right? And another big reason that people don't have money for the essentials and have to put them on the Amex, the MasterCard, or the Visa is because of shelter costs. Shelter costs are skyrocketing year over year, up 6.2% month over month. In a lot of markets, that's up 10, 20, even 30%. And make no mistake, the cracks of this are already showing. Don't let anybody tell you, oh, it's okay if people have record credit card debt and income isn't keeping up with inflation and they have to put all the essentials on a credit card. Don't care about that. As long as Wall Street analysts are doing fine and their families are doing fine, we're not going to downgrade any company earnings. According to a recent report by LendingTree, 32% of Americans have paid a bill late in the past 6 months, and 61% said it was because they didn't have the money on hand to cover the cost. So right now we are still early in the cycle of Fed tightening. We are still in the very early stages of seeing the ramifications of that Fed tightening, and you're already starting to see Americans that can't can't even pay their bills, have to pay them late, and don't have any cash to cover the cost. And at the same time, you have government officials that will not acknowledge that this is a problem because it looks bad, or maybe because they just personally don't feel the effects. I don't know. You have Treasury Secretary Janet Yellen coming out just yesterday and saying the U.S. economy is doing well. How can you say your economy is doing well when the vast majority of participants in the economy are relying more and more on credit cards just to survive and buy the basic essentials? And I don't mean this to criticize people who are on the left or the right. I mean this to criticize anybody who's trying to sell this economy as strong, as resilient, when in fact it is not. It is not. Right now, we are in an economy that has just seen 2 consecutive quarters of negative GDP growth, 4-decade high inflation, and insanely ballooning levels of debt across both private and public sectors. That does not sound healthy. That does not sound good to me. Maybe we are doing well compared to Somalia. I will give Yellen a credit on that. She's right. We're doing better than Somalia. But when you compare this economy to the economies that we've seen pre-pandemic, it is nowhere near that. It is nowhere near on the right trajectory. But I think the bigger picture here, and this kind of builds off what I was talking about with Bernanke yesterday and his Nobel Prize, this idea that we are doing well is based on this new definition and new ideology about how a financial system and economy should be run. It should be run with excessive debt and excessive leverage really throughout every part of it. Debt, overspending, overprinting, and excessive central bank power, those are what we should celebrate in a good, healthy economy, according to people who follow this ideology. Look at this quote from a Market Watch article back in the summer. Quote, "How much credit households use is seen as a good window into the strength of the economy." Again, how much credit households use is seen as a good window into the strength of the economy. Consumers tend to borrow more when times are good and cut back when times are tough. This is how the U.S. government and economists at the Fed and Wall Street think. More debt, more enslaving of the populace to lenders, that is good news. That means that we're in a great economy. When people who follow this ideology see a stat that says nearly 78 million Americans used buy now, pay later in the past year, they think, oh, that means that we're in a huge booming economy. That's a huge win. When I see that, though, I see a ticking time bomb. I say, oof, this is terrible. Yes, obviously there is good debt and there is bad debt. If you're going and you're borrowing money to build a business or try to grow a business, that's good debt. If you're trying to borrow to buy a house to start your family, that's okay debt. And if you're trying to take out money to get a car loan, okay, fine, you might have to do that. But if you're going and you're taking debt out just to pay for the essentials and just to survive week to week, that is a disaster. Yet policymakers, they don't distinguish. They look at all the debt and they say, okay, this is just fantastic. People have so much debt. Oh, that means we're in such a good economy. When in reality, it only accelerates the economy until the debt can't be repaid and until all of a sudden central banks have to freak out and panic and raise rates to insane levels, which we are going through the process of right now. The fact of the matter is that if you have to take out debt to buy groceries, that is not a booming economy. That is a desperation economy. And we are just in the beginning of this cycle, this big cycle downward that we are just starting to experience. And it will get much worse into the next year unless the Fed pivots. And if the Fed pivots, that's a whole nother problem. But anyways, speaking of the Fed, let's go over to Bullard. Chairman Bullard has been one of the only inflation hawks this entire time. When Powell was saying transitory, Bullard was saying no transitory. And because of his correct early calls, people now kind of see him as a sort of non-consensus thought leader that leads the rest of FOMC participants in this current cycle. He kind of forecasts where the Fed is heading. And according to Bloomberg today, Bullard said that a pivot is unlikely to be any time soon. Quote, "It's a little premature to say when we declare victory. The near and medium term goal is get moving in the right direction." So he is not saying, oh, it's premature to declare victory. He is saying it's premature to even say when we could even think about declaring victory. That's a whole other level. Just a few months ago, Wall Street wanted to declare victory over inflation just because you had a pansy drop. And then he says the near and medium term goal is get moving in the right direction towards that 2% target, and the month-over-month trend on the PPI report just came out positive again, which means we are not even moving in the right direction. We are moving in the wrong direction. If the CPI report does the same, that gets us even farther from that goal. I actually think when we come out with the CPI tomorrow, there's going to be a chance that a few crucial line items are being marked down because retailers can't move their products anymore and they overstaffed on them or they overstocked on them. But that just avoids one economic issue and swaps it out for another. This dynamic where, again, Again, if the CPI is hot, consumers are getting screwed. If the CPI is not hot, businesses are getting screwed. It's bad news across the board. And what's crazy is the Fed's FOMC meeting minutes just came out like 20 minutes ago, and I read over them, and they kind of just parrot Bullard's warnings. Quote, Federal Reserve officials have been surprised. Really surprised at the pace of inflation, and indicated at their last meeting that they expect higher interest rates to remain in place until prices come down. Participants judged that inflationary pressures would gradually recede in coming years. Oof, long road ahead of us. They're going to gradually recede in coming years. Does that sound like a quick pivot? Does that sound like something the Fed's going to say next quarter? Oh, okay, they're going down very, very slightly. Let's go ahead and completely pivot. No, it doesn't sound like that at all. The economy is going to have to go into a massive, massive bloodbath very, very rapidly if you want to see any kind of substantial Fed pivot. So when people say, oh, unemployment is super, super low, that's great news for the market, I'm like, what are you talking about? That just means the Fed is going to go even more aggressive with their policy hiking, and that means this is going to be a much, much longer-winded budget, which leads us over to company earnings. So earnings season really starts at the end of this week, and I believe we are going to see some really disappointing numbers for Q3 and even more disappointing guidance, if not complete suspension of guidance, similar to what we saw in 2020 during that COVID drop. But when you are watching these numbers come out, keep in mind that these numbers are basically as good as it's going to get for the next year, unless the Fed pivots. It's as good as it's going to get because the Fed is doing its part to make sure that the economy contracts as much as possible. So overall, consumers are going to be more and more gutted as we go into 2023. So the numbers that we see in Q3, that's about as good as you're going to see anytime soon. In Q3, the strengthening dollar has greatly hurt the competitiveness of American companies on a global scale. Consumer demand here at home is dying, profit margins are getting crunched, supply chains are still out of whack, and things look to only get worse. If you look at survey after survey, it shows that business leaders accept that, hey, this is a disaster. We are going through a very, very rough time, and the Fed is only going to make it worse with its monetary policy medicine. But at the end of the day, once the Fed has destroyed everything, then they'll be able to rebuild, I guess. Now, if you would like to learn how to battle in this very bloody stock market and build a solid foundation for your trading, I will put a link to ZipTrader you below. This program includes our step-by-step lessons, our private chat, our daily morning briefings where we brief on all the biggest catalysts and battlefields and opportunities that we see each and every market open morning, and of course our full price target list. Our Flash 40% off sale on this program will be ending shortly on Friday the 21st, which is next Friday. So if you are looking to take advantage, make sure to take advantage before the sale ends. Anyways, I appreciate your viewership, and we will see you in the next video.